Are you the person that looks at the portfolio multiple times a day, every single day, and makes adjustments based on emotion? Or are you the other person that completely ignores their portfolio? This is where systematic discipline can be important, in hoping to avoid either of these two scenarios. The investor that completely ignores their portfolio over time doesn't necessarily take into consideration how their life has changed, how things could have become more complex, how their income could have fluctuated, or merely the fact that they could be nearing retirement. And on the other hand, the person that is hyper-emotional about their portfolio and checks multiple times a day could end up making many irrational decisions over time and costing themselves significant sums of money. A more systematic approach that I like to follow is having regimented, scheduled reviews. Perhaps quarterly monitoring updates, in addition to a comprehensive annual review where you could consider rebalancing, tax planning, and estate planning reviews. This could potentially help one remove their emotion from the decision. And rather than wondering, should I be doing something right now, maybe pivot and ask, is my plan going according to how it should be? And something that I would like to hit on is the potential for the hidden costs of overanalyzing and over-allocating your portfolio over time. This is what I refer to as behavioral cost, which is the tendency to make emotional decisions which could end up leading to mistakes. Studies have shown that investors that tend to check their portfolios on a more regular basis, or even in an obsessive manner, could end up making reactive decisions which could end up undermining long-term results. To keep it simple, consider this 5-pillar approach. Number 1, asset class diversification. Are my assets and investments aligned accordingly with my goals and in my best interest, whether that be stocks, bonds, real estate, or even cash? Number 2, geographical diversification. Do I feel more comfortable aligning with companies that are based solely in the United States? Or should I have exposure abroad? Number 3, sector diversification. Am I overly weighted to any particular sectors of the market? And if so, is there a reason for this? Number 4, time diversification. And this relates back to the liquidity ladder and having an understanding of how your portfolio is spread out, what capital is accessible immediately, and what is invested for the long term. And lastly, tax planning diversification. Understanding and knowing full well where your assets are situated, whether that be pre-tax accounts, Roth accounts, or non-retirement accounts.